Hey, what's up, everybody? Welcome back to Investing Sucks. So, in this video, we're going to be doing another backtest video where we take a look at some deep value investing strategies detailed in a pretty popular investing book called The Acquirer's Multiple. So, this is a book that came out pretty recently and it's written by someone named Tobias Carlisle. And it's pretty similar to the little book that beats the market in that it's designed for beginner audiences. And it's rather short and it talks about a very, very simple method that you can supposedly use to beat the market. And it also makes the very bold claim that its method, when backtested, actually produces even better results than the magic formula described in the little book that beats the market, which also happened to beat the market, hence the title, right? So what I'm going to do in this video is I'm going to take an in-depth look at some of the investing strategies that were talked about in this book and try and understand why it is that these actually do beat the market, if they do actually beat the market, and if it's something that we can learn from and hopefully utilize in our own personal investing. So I've done a similar video like this in the past on the magic formula method, where the whole point of that was to see what it's actually like to use those investing strategies in practice, because I find with a lot of these investing books, they're very theoretical, right? And they don't actually get into a granular level of detail that I think a lot of serious investors like you and I would like to see, because that can help us understand the actual logic rather than, just hearing the theory behind it. So first, let's discuss what the acquirer's multiple actually is. So it's really just a valuation metric that compares enterprise value to operating earnings. And it states that this metric is better than using market cap, for example, as you would with, say, a PE ratio, because enterprise value can uncover what they refer to as hidden value, right? And what the author means by hidden value is that if you use enterprise value, you're going to prefer companies with relatively large cash balances and low debt balances versus, the opposite, companies with high debt balances and low cash balances, which are supposedly worse investments because that may indicate solvency issues down the road. So because enterprise value, it's calculated as just, the market cap plus total debt and preferred shares if the company has any, plus any non-controlling interests if they have any. And then you subtract cash and also idle investments that can easily be sold at fair value on an open market, which is quite similar to cash. So companies with a lot of cash and not a lot of debt are going to have a relatively lower enterprise value and thus appear more cheap using the acquirer's multiple. And ideally, by buying cheap companies, that should lead to better returns down the road. And this is really meant to be a way of identifying what they call fair companies at wonderful prices, which is a phrase that Warren Buffett popularized. You may have heard the phrase, it's better to buy a wonderful company at a fair price as opposed to a fair company at a wonderful price, which is certainly true for guys like Warren Buffett that have that level of investing knowledge where they can identify what a wonderful business actually looks like. But the reality of the situation is that you and I are not Warren Buffett, right? And that level of investing is like cooking at a Michelin star restaurant, and you and I can't even make toast at this point. So for us mere mortals, it doesn't really work, and we're better off just placing our focus on companies that are at good prices and offer us a margin of safety rather than trying to figure out what a wonderful business looks like. And this is what the book actually argues. But the issue with this is that companies that are cheap are usually cheap for a reason, right? Whether it's a valid concern with the business or perhaps even an invalid concern with the business. So, what the author then points out is what he refers to as mean reversion, which is this graph here that I had up briefly earlier. So, this is mean reversion. What it's looking at here, as you can see, there's ROIC, so return on invested capital, which is a barometer for business quality. Higher return on invested capital usually means it's a higher quality business. Less WACC, so weighted average cost of capital. So it's basically the difference between how much a company pays to acquire capital and then how much money they make by deploying that capital into their business and earning returns on it. And what it shows here is companies that had a relatively higher difference, so a high return on invested capital, less weighted average cost of capital over time. So at the bottom here, the number of years following portfolio formation, it tended to go down, right? And then companies that had a lower one actually went up. So that's mean reversion, right? They're reverting to the mean. And this is kind of the natural forces that you see in businesses where, if there is a certain industry that has high returns on in capital, that's going to attract competition, right? Because, other people want to make money. They see that there's money being made in this business, so they enter that business. versus companies that, have low returns on invested capital. People aren't going to be as enticed to enter that business. But over time, because, competition kind of, equates and it mean reverts, you tend to see a pattern like this. And this was research that they presented in the actual book, which I thought was pretty interesting, because that's something you can certainly use in your own personal investing, right? Especially if your goal is to, you're a value investor, you want to find undervalued companies, you would look at an industry that is currently, at the lower point of its cycle. And if this mean reversion thing holds true, then you should see that correct into the future years. And maybe people are ignoring that industry because they think that, well, it's got low returns on invested capital, I don't want to be in that business. Versus there's, businesses that are earning abnormally high profits, high returns on capital, where the revenues, earnings, cash flow, those are all growing. And then investors, what they will assume on those businesses is that trend is going to continue into the future. And that's often not a true assumption, right? Because like we said, high returns on capital invites competition. Competition forces companies to lower their prices, which drives down profits. And thus over time, they revert back to the mean. So the one exception to this rule, which the book also describes, is the wonderful businesses, right? Those businesses that have the ability to sustain high returns on capital, indefinitely and well into the future. So think Google, Apple. So you may think, I want to find those companies, right? How do I find those companies? Well, the problem is no one knows. And there's been research on this. How do you identify those, like, unique companies that do have that characteristic? There's really no way to do it, unless, of course, you're Warren Buffett. So everything I just talked about there, it sounds good in theory, right? It seems to make sense when we listen to it and we apply our investing knowledge to it. But what I wanted to actually see was what this looks like in practice. So there's two strategies that I wanted to backtest today. And what I'm going to do is what I usually do, which is a 5-year backtest, where we assume that we buy a portfolio of each of the stocks that each of these lists that I'm going to talk about generates for us. And then we invest in all of them at market cap weights, and we hold them for the duration of those 5 years without rebalancing along the way. And we also reinvest any dividends that we receive along the way. And to be clear, I'm not backtesting the exact strategy that's used in the book, because in the book they did run a backtest on that strategy themselves, and they used a much richer data set than I'm dealing with here anyways. So I figured what would be more useful is to backtest the other strategies talked about in the book that supposedly will ensure that you're buying fair companies at wonderful prices. So one strategy that was mentioned in the book is buying stocks based on just purely the acquirer's multiple, which we already talked about what that is. So I went with a acquirer's multiple of 5 and below. So what this script does here is it generates a list of companies with an acquirer's multiple of 5 or below. And by the way, if you're wondering what this website is I'm using here, it's called tickernomics.com. It's a website that I created to help retail investors analyze stocks. And one of the features that it has is the ability to do these types of back tests, and also to generate these scripts, which can help automate investing tasks for you, like generating lists of pre-screened companies. So that's what I'm doing here. I'll leave a link in the description of this video if you do want to check out this website. So how does this script work? Well, I have it here in the public scripts. And if you want to run this for yourself, then you can just go to public scripts. You click save to my scripts here, and then it will bring it to the my scripts window, which you can then run it in. So there's the code for it right there. And then if I click run, it'll take a few seconds and we can see the results appear here, and it'll generate the list of the companies that meet the results as of today. Now, obviously, I did a back test and I did a 5-year one, so I also created a script that does it as of 5 years ago. But just to show you, to give you a flavor of what it's like, if I go to the insight tables, now the list has been generated, we can see what this list is here. So these are some of the companies. You'll notice, in the name column, we've got the industry and the sector as well, and then the company name, and then some stats. So what their market cap is, what the acquirer's multiple is. Some of them even have negative acquirers multiple because they have negative enterprise values, and then also what their operating earnings are here. So that's one. The other one is companies that have negative enterprise value. And by the way, from both of these lists, I excluded financial services businesses, because with those types of companies, their valuation metrics tend to work differently than other companies. And I did notice, including them, they were kind of dominating the list and probably skewing the results. So later on, when I talk about the results of the backtest, I didn't want them to, skew the results too much, so I decided to just exclude them. So when you're buying a company that has a negative enterprise value, remember enterprise value is lowered by the amount of cash and idle investments that the company has. So if the company has more cash than the sum of their total debt and the sum of their market cap, in essence, you can think it as if you're getting paid to take over that business, right? If you're investing in them because you're buying a business, you're investing in part of their equity, which is their market cap, but they have more cash than their market cap and their total debt combined. So in theory, you could just buy the entire business, pay down all the debt, and then with the cash, and then you just have the leftover cash and you would make money if they have negative enterprise value. Which again, that sounds good in theory, but in practice, it doesn't actually work because usually whatever a company is selling for on the stock market, in order to convince every single investor of that company to sell their shares to you, which you would have to do if you're trying to take it over and liquidate the company, you're going to have to pay higher prices than what it's currently worth on the market because some people aren't going to agree with the current market price. They're going to think it's undervalued, or some people are going to want to hang on to their business. For example, say it's a biotech company and it's not even really a company, it's really just someone's science experiment. They're not going to want to sell you their shares because they care more about the business rather than making money from it. These are all things that are very real and, certainly considerations when following that strategy. So it's not just so simple as it might seem. Okay, so let's dive into the actual results of the backtest. So really what you came here for. So you can see here there's this one script called the acquires multiple below 5 backtest. And if we scroll down, there will be also the negative enterprise value backtest one, which is right here. So I'll run this one just to show you what kind of companies appear. I did already summarize the results though. So we can see it's done running. So we have to go to the insight tables to look at the list. So here's the back test. So this is all as of 5 years ago. Here are our companies here, along with their cash balance, their total debt. A lot of them have zero debt, and then the market cap as well. I've noticed a lot of foreign companies are appearing here as well, which is definitely interesting. And then what we can do is click this button here to export to Excel so we can analyze the results a bit more. Now I've already done that, so I'll move my Excel file here and we'll go through the results. So really what do we care about, right? How well did this portfolio of stocks do? Well, the answer is really not that great. So the total return, and this is CAGR, compound annual growth rate. So this is for each of the 5 years. Under the acquires multiple below 5 method, you would have lost just under 5% per year. So 5% each year for those 5 years. And then the negative enterprise value one was even worse. You would have lost 8% per year. So that's not really that great, right? And let's go through a few more stats before we, jump to any conclusions here. The total amount of companies that we had, the acquires multiple below 5, there are 25 companies that appeared on the list, which are these 25 companies here. The negative enterprise value one had 45, so there are a lot more companies, which are these companies here. And in total, I wanted to look at the number of companies that you would have made money on versus the companies you would have lost on. So the answer, it was pretty similar for both. There were 17 companies that you would have lost and 8 companies that you would have made money on under the acquires multiple below 5 one. And then the negative enterprise value one, 32 of them lost money and 13 of them won. So 13 of them gained money. And then also, how does the industry breakdown work? So what types of industries were we finding ourselves investing in under each of these strategies? So it was a little bit different for both. You do notice a heavy concentration, at least in the negative enterprise value one, towards healthcare. This is kind of what I was talking about before with these biotech companies that are basically science experiments. I think one of the reasons why this happened. But other than that, it was pretty spread out amongst the industries. I mean, it's certainly a different industry makeup than if you were to look at the S&P 500, but I didn't really see any striking trends here, other than, the high concentration in healthcare companies, especially for the negative enterprise value one. That I thought was interesting, but also kind of expected, I think. But, pretty balanced between them. You can see industrials, a few tech stocks as well. And then what's also interesting is to look at the distribution of returns. So that's what this is here. So this is what I'm looking at here, these two graphs, is on this axis, you have the annual returns. So this was for each year of the 5 years. and then each dot represents a different annual return. So we can see it's pretty scattered. This is the acquires multiple below 5 one. You had some that did really well, right? You had one here that gained, 55% each year for those 5 years. Some that certainly outperformed market, but there were a larger amount that underperformed. And you can see a very wide range because, there's companies that would have lost you, over 40% per year, but then companies you would have made 55% per year. And then pretty similar for the negative enterprise value chart here. Very, very scattered, which to me indicates this is a high risk strategy. This is a strategy that is not for the faint of heart. You definitely need a stomach to deal with this. But if you are able to, look through this list and decipher which of these companies would actually, constitute good companies as opposed to companies that you can easily weed out, like, the biotechs or anything else that seems to not make sense, then overall, maybe you'll be able to find some pretty strong winners using this strategy. But the limitations, so I want to discuss a few limitations. So because I'm doing a 5-year backtest, it doesn't really account for companies that had been, taken private, acquired, or merged, or if they even happen to go bankrupt, because in order for the company to appear on this list, they have to exist today. And then you also have to consider timing. I did notice a few of these companies where overall over the 5 years they actually lost value, but there were points in time where you could have sold at a substantial gain, right? And if you're invested in this company, you're probably going to be paying attention to that along the way. You're not necessarily just going to wait 5 years for that, supposed mean reversion to take place, which the book describes. But I think, this strategy, it's pretty insightful because it shows you that if you apply it in a certain way, you can 100% find companies that are going to produce very sizable gains, but it is at the risk of, plenty of companies that you could lose money on. So, the adage that was described in the book of these being companies, good companies at wonderful prices or fair companies at wonderful prices, some of them are, but definitely some of them are just bad companies at bad prices. So while a lot of what this book talks about may sound really good in theory and sounds like it could be a foolproof investing strategy, I think you do need to be careful when actually following these methods. And I'm not trying to make this video to expose or, debunk the acquires multiple claims, but more so to point out the challenges that you will face if you just blindly follow a supposedly foolproof investing strategy. And maybe it's also the case that my backtest just wasn't long enough, right? And these companies just need more time to have their financial results, revert back to the mean and improve into the future. But at least from looking at the list, it definitely seems like you could find yourself down big on a lot of these companies. And it is an extremely risky strategy, as we saw from the very high variance in returns. And this kind of goes against value investing wisdom, right? Which claims that deep value investing is minor risk with huge upside potential, right? It's like heads I win, tails I don't lose much. But at least for the average retail investor, they probably don't really have the stomach to deal with those kinds of variances in returns and to deal with seeing their positions go down, negative 40% each year for 5 years. We have to acknowledge the emotional and the psychological element of investing as well, because if you commit to this strategy, you are going to have to deal with that at some point. And if you're not well equipped to deal with that, then it could lead you to not following the strategy and perhaps not having the returns that you were promised. So if you are interested in exploring these strategies a bit further, just make sure you check out my website, tickernomics.com. It's currently free to use, so you can check out this script as well as all the other scripts that we have in the public scripts library here as well, and you can leave comments on them if you have any suggestions for me. But anyways, guys, I hope you did find this video useful. If you did, then please leave a like, and if you're new to my channel, I'd appreciate it if you would consider subscribing, and I'll see you guys in the next video.